Module Overview. IAS 8. Accounting Policies, Changes in Accounting Estimates and Errors provides comprehensive guidance on how to select and apply accounting policies, recognize and present changes in estimates and policies, rectify errors from prior periods. This standard plays a critical role in enhancing comparability, transparency, and consistency in financial reporting over time and across entities. IAS 8 ensures that financial statements faithfully represent financial performance and position, and any adjustments are made appropriately when new information emerges or errors are discovered. Accounting Policies. Definition: Accounting policies are the specific principles, bases, conventions, rules, and practices applied by an entity in preparing and presenting financial statements. Selection of accounting policies. Entities should follow IFRS standards. Apply standards directly if applicable. In absence of a specific standard, consider requirements and guidance in similar IFRS standards. The conceptual framework. Definitions and recognition criteria for assets, liabilities, income, and expenses. Consistency. Once adopted, policies must be applied consistently for similar transactions. Consistent application ensures comparability across periods. Changes in accounting policies. A change in accounting policy occurs when a new IFRS standard mandates a change. The change results in more relevant and reliable information. Application: Changes in policy must be applied retrospectively unless impracticable. Restate prior period figures as if the new policy had always been applied. Disclosure requirements, nature of the change, reasons for the change, amount of adjustment for the current and each prior period. If retrospective application is impracticable, state the reason. Examples: switching from FIFO to weighted average inventory valuation, changing from cost model to revaluation model for property, plant, and equipment. Changes in accounting estimates. Estimates involve judgments based on incomplete or uncertain information. They are adjusted when new evidence or experience becomes available, not because of error or policy change. Examples: useful lives or residual values of assets, fair value of financial instruments, warranty obligations, allowance for doubtful debts. Application: apply prospectively from the date of change. Do not restate prior periods. Reflect changes in current and future periods only. Disclosure requirements, nature and effect of the change. If the effect on future periods is not disclosed due to impracticality, that must be stated. Prior period errors. Errors may arise from mathematical mistakes, misapplication of accounting policies, misinterpretation of facts, fraud or oversight. Correction of errors. Must be corrected retrospectively. Restate comparative amounts for prior periods. Adjust opening balances of assets, liabilities, and equity for the earliest period presented. Disclosure requirements, nature and amount of the error, periods affected, explanation if retrospective restatement is impracticable. Impracticability and exceptions. When retrospective application or restatement is impracticable due to undue cost or effort, the entity must apply changes from the earliest practicable date. Disclose the nature and reasons for the impracticability. Clearly communicate the limitation to financial statement users. Summary table of approaches. In this module, we will be using type, definition, application, restatement required, and example in our table. 1. Accounting policy change, new standard or voluntary change, retrospective yes switch to fair value model. 2. Accounting estimate change, new information about uncertain values. Prospective no change in useful life of asset 3, prior period error, mistake in previous report. Retrospective yes missed depreciation, fraud, etc. Case study. Comparing policy versus estimate versus error. Scenario: an entity changes its method of depreciating equipment from straight line to reducing balance. Is it a policy or estimate? It's a change in accounting estimate because depreciation method is based on estimation of asset usage, thus apply prospectively. Scenario: an accountant omitted revenue recognition for a major contract in last year's report due to misinterpretation. It's a prior period error, requires retrospective restatement and disclosure. Summary of key points. IAS 8 distinguishes between policies, estimates, and errors. Policies are applied retrospectively, estimates prospectively, errors are corrected retrospectively. Disclosure is critical for transparency. Entities must document the reasoning and methodology used in changes or corrections.